Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to the Divorce the IRS Podcast. Today, we explore the concept of the three tax buckets and which one or combination of buckets might be right for you. When you earn income and after you've paid your bills, you have a choice about where to put the money that remains, assuming you haven't spent it all. There are many different types of accounts and investments out there, and they're not all created equal. Each has different benefits and pitfalls. Thankfully, we do not need to discuss every type of bank account and investment product and insurance policy, as they all fall into three main categories. In this episode, we will review these categories, or buckets as I like to call them, so you can start to see the opportunities they offer. The three tax buckets that all accounts and investments fall into are the Tax Me Now, or taxable bucket, Tax Me Later, or tax-deferred bucket, and the Tax Me Never, or tax-free bucket. What's important about these buckets is the types of accounts each one holds, not the actual investments. You can buy a stock or any investment in any of these three buckets. Which account you buy the investment in determines which bucket it goes into. Let's have a look at each one. The Tax Me Now bucket, also called the non-qualified bucket, includes any type of account for which you receive a 1099 form on an annual basis. The money you deposit into these accounts and the investments within these accounts has already been taxed. You will owe taxes annually on any growth, gains, or interest you realize in these types of accounts. The most common type of Tax Me Now account, which almost everyone owns, are bank accounts. The money you deposit into the bank each payday has already been taxed. You get a 1099 from your bank each year declaring how much interest you earned, which you need to include on your tax return so you can pay the taxes due at ordinary income tax rates. Let's take a look at an example. If you have $50,000 in a one-year certificate of deposit at the bank and it grows by 2%, you have a taxable event. At the end of the year, you will have $51,000 and you will have to pay federal and state tax in most states on every bit of that growth. So the $1,000 of interest gets added right on top of all your other income for the year and is taxed at your highest marginal rate, the brackets that we discussed in the last episode. Now, assuming you're in a 30% bracket composed of 24% federal and 6% state, as an example, you would owe $300 in taxes on this interest. This means you didn't really experience $1,000 of growth. Net, you only experienced $700. Thus, your after-tax rate of return on that $50,000 was only 1.4%. This annual taxation is one of the problems or drawbacks with the taxable bucket, as not all the interest is left to compound if you have to pay some of it to the IRS every year. The other common accounts often found in the non-qualified Tax Me Now bucket are regular non-qualified mutual fund or brokerage accounts. Those who want easy access to their money but prefer to invest in something with higher potential return than a bank account usually look to mutual funds or brokerage accounts. In a brokerage account, it's possible to invest in a plethora of investments like stocks, bonds, exchange-traded funds called ETFs for short, mutual funds, commodities, precious metals, real estate, and others. Although some of these investments don't get taxed annually, but rather when they're sold, all are still taxable as gains are realized on them. Some investments in this bucket can also have more favorable tax treatment, like capital gains tax, which can be lower than ordinary income tax. And it's great to learn more about capital gains tax, but that's beyond the scope of this episode. Now, a little fun fact. Gold and silver are not considered investments by the IRS. They're considered collectibles. Thus, if you hold it longer than a year, you must still pay ordinary income tax rates up to a maximum of 28% on any gains realized, instead of the more favorable long-term capital gains rates of 15 or 20%. This can make gold or silver a less attractive investment for many people. Now, why use the Tax Me Now bucket? The answer is liquidity, or access to your money. The money that you generally have in taxable accounts, and thus Tax Me Now type investments, is liquid and accessible. There is no penalty from the government for using this money. As many financial advisors will tell you, it's important to have at least 3 to 6 months worth of living expenses stashed in an emergency fund. Tax Me Now bucket accounts are most suitable for this money. This bucket is also the most suitable for other short-term savings goals, like a down payment on a home or a new car or a wedding. Now, the Tax Me Later bucket, also called the tax-deferred bucket, is the most popular bucket for retirement savings in America, much to the delight of the IRS, and the one that will absolutely tie you to the IRS forever, which is their goal. If you want to divorce the IRS one day, this is probably not where you want to save most of your money, which we will discuss in much more detail in many future episodes of this podcast. This bucket includes any retirement account to which you have contributed money on a pre-tax basis, such as most traditional IRAs, 401ks, and 403bs. There are others as well that have different rules, like the SEP, the Simple, the KEO, and 457 plans. This might be the bucket you contribute the most money to. And why not? Out of sight, out of mind. This bucket makes saving for the future easy. Plus, everyone's doing it, so it seems like a no-brainer. Plus, you save a little on your taxes along the way. Nice. Well, maybe not as nice as you think, as we will soon explore. No matter the type of Tax Me Later account you use, you'll find they generally have three things in common. First, contributions are deposited pre-tax. Generally, when you contribute money to any of the accounts in this bucket, it is done pre-tax and you receive a tax deduction for the contribution. For example, if you make $120,000 this year and you put $10,000 of it away in your traditional 401k, your taxable income drops to $110,000. Second, the growth is tax deferred. As you earn interest and experience growth from the underlying investments in the accounts, you don't have to pay any tax. All the tax will be collected later when you withdraw the money from these accounts. And third, withdrawals are considered ordinary and provisional income. You pay taxes on all the money you take out of these accounts as if you earned it at a job, minus Social Security and Medicare tax. You also pay taxes on the money at whatever your state and federal tax rates happen to be the year you take the withdrawal. We will look at what provisional income is later in this episode. Now, many have likened the Tax Me Later bucket to the concept of a farmer having a choice as to when he or she must pay taxes. Do you think a farmer would like to pay tax on their handful of seeds now or on their entire crop later at harvest? Most would say paying on the seeds now would be a wiser move, providing a tax-free crop to harvest later. But by putting money into the tax-deferred bucket, the farmer is foregoing tax on the seeds for the liability of paying taxes on the entire crop one day. Finally, the Tax Me Never bucket, also called the tax-free bucket, is the key point of this podcast. This bucket includes accounts to which you contribute after-tax money for retirement, such as Roth IRAs, Roth 401ks, and Roth 403bs, and life insurance retirement plans, also called LIRPs. There are others as well. You do not get any special tax breaks up front with this bucket, but all contributions and growth can be withdrawn income tax-free for qualified reasons, which generally means you're at least 59 and a half years old and have had the account open for at least 5 years. Using this bucket is like the farmer choosing to pay tax on the seeds and no tax on the entire harvest down the road. It's important, though, not to be fooled by investments that masquerade as tax-free, like municipal bonds. Municipal bonds may be, in fact, federal tax-free, but unless you purchase them from the state you live in, they may not be state tax-free. And if they gain in value, not just pay interest, due to the fluctuations in interest rates, you may also have to pay tax on the gain. Municipal bonds should be considered tax-efficient in some cases, but never tax-free. Another important concept to understand is provisional income. This is the type of income the IRS counts when determining how to tax you on certain things. To be truly tax-free, an investment or investment account needs to provide income that cannot count as provisional income. This is income included in the calculation of Social Security tax or Medicare premium adjustments. Municipal bond interest does not fit this bill, as it is considered provisional income. Real estate and rental income is also included in provisional income. We will discuss more about real estate and provisional income when we dive deeper into Social Security taxes later. Remember, the key is to understand which bucket an account fits into before you decide where to put your hard-earned money. The Tax Me Now bucket commonly includes bank accounts, mutual funds, and brokerage accounts, and is useful for liquidity and short-term savings. The Tax Me Later bucket is the most popular and least beneficial for retirement savings, and I'll make my case for this statement in more detail in upcoming episodes. The tax me never bucket is very important and underutilized. Most people do not understand all the benefits that investments in this bucket can have on their future. They are unaware of the compounding tax time bombs they are creating by not contributing more to this bucket. It's also important to determine your ideal number, as we will discuss in more detail later, for the tax-deferred bucket and not to exceed it. This is the amount of money you should have in tax-deferred accounts upon reaching retirement. You can also use the online calculator at divorce-the-IRS.com to figure out what your ideal number should be, if you like. You should then consider strategies that allow you to shift money to and accumulate most of your retirement savings in the tax-free bucket. We're going to cover all of these strategies in upcoming episodes. Keep listening to the next episode to learn why and how to take advantage of the tax me never bucket, no matter what your circumstances may be.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-IRS.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.